Hi folks, and welcome to another episode of Trader Café. So today what I plan to do is talk a little bit about some of the fundamentals that have taken place in the market. It's such a big week this week. And also then we'll go on to look at the Super 7 markets and try and get a better technical picture of where they lie on. So for me, from a fundamental perspective, the key thing is the Fed pivot. And this is not a great surprise, I don't think, to many people. Inflation is getting high and higher. We'll have a look at that in a second in the States compared to history. But you've got a combination here, right? So what's been happening is there's been fiscal stimulus from the government spending money to help people through the pandemic. And at the same time, you've also had substantial monetary stimulus from the Federal Reserve, both through interest rates and through the purchase of assets. And that's been a pattern repeated around the G7 or G8. Maybe if we exclude China from that for the time being, they have a slightly different part of the economic cycle going on there. And so what we're going to do is we'll have a look through that. We'll have a look at a few charts around that to reinforce our views. Also have a look at maybe try and get a feel for the future, right? Because this is where things are getting very important. You know, I view this as quite a tipping point at the moment. We have in the past had both central banks, government, and also sentiment, as a backwind, if you like, to help investors over the course of the last 2 years. I'm not quite sure that going forward we're going to have any of those, which is one of the reasons why I'm quite nervous about the performance of quite a few asset classes going forward over the next 12 months, but most notably stocks, which I think have a relatively extreme sentiment position at the moment and are vulnerable. And we'll also go and look at the broad technicals as well too. The key thing for me is the rate of inflation has changed markedly from the 1 to 3% corridor that the Fed had to now nearer 7% in the United States, and it's also rising in other jurisdictions around the G7 and G8. I think here in New Zealand it's 5%, Australia it's about 3.5%, the UK is about 5%, and Europe I think is about 5%, just under 5% as well too. So quite a substantial rise in inflation, but that's also part of that is inflation expectations as well too. The reason why I think the Fed has pivoted, because up till this point in time, the Fed hasn't worried too much about inflation. It's much more concerned about the level of unemployment post the initial stages of the pandemic when so many Americans lost their jobs. But now we can see that from the inflation impact is beginning to strike into the core heartland of the Biden and the Democrat voter camp, right? So this is the government shifting. So it's unsurprising to me that the Fed has been encouraged to start to think more about inflation, whereas in the past they haven't been targeting it that closely over the course of the last 18 months. They're now starting to be encouraged to think about it because people in government have realized that the effects of inflation are actually quite dangerous, difficult for parts of marginal society and lower income voters, and this does affect them. It's the same old adage, right? If the price of gas goes up, then people get grumpy in the States. So I think what I'm seeing here is this combination of fiscal and monetary stimulus. So the government spending an awful lot of money, the Fed buying assets and cutting interest rates enormously has led to this excess stimulus. Now this hasn't really been seen for years and years and years where we've had this approach. I think there was, when I looked at the history books, the previous analogue that we can go and look at around this is probably sometime around the Vietnam War, where something similar happened. That led to a relatively inflationary period in the 1970s. But I think, we have the benefit of history now. And we also understand that obviously that higher inflation rate does affect people on lower incomes. And as a result of that, they tend to get grumpy. And so what we're looking at now is we're seeing, right, that stimulus point has now got past because we're starting to remove some of the stimulus. We need to think about getting the inflation back under control again. We all get a one-off. But I think what the government is really trying to say and what the Fed is trying to say is that we don't want this to be sustained. The difficulty is stopping it, right? And this is the key thing, right? So have we, if you like, set the ball rolling down the hill, and can we do a lot about it? Well, the Fed's going to try. And I think that's the key message here, right? The Fed is going to try. And it's this move from worrying about the very high levels of unemployment after the pandemic. We can see this from the red line and also from the blue line as well too, worrying about that. And so what the Fed has done is they've said, right, we're going to wait until we see unemployment get down to that natural rate, get down to the 4%, 3.8% level, before we're even going to think about doing something in interest rates, right? And they weren't really thinking about inflation. Well, this pivot for me is the Fed now saying, okay, unemployment seems okay right now. Now we've got to do something about the inflationary side of things. And I also believe that this is one of those situations whereby you have extraordinary financial conditions. You know, this is about as easy from a financial conditions perspective as it's ever been. And I think this is quite important in terms of asset prices as well too. So this gets back to really supporting my thesis that essentially everybody's had your back if you're an investor. And I think that's changing. So if it's changing, what we've got to think about is what that means. Now, one of my most favourite investors is a guy called Stanley Druckenmiller, and he has a very simple attitude to the way in which he invests in pretty much any assets. And he says it's all about liquidity. It's not about earnings. It's really the movement of liquidity that makes the difference. Okay, so then you think about that. Okay, so what does that mean? So liquidity is the Fed buying bonds and increasing QE. Liquidity is the Fed reducing interest rates, getting the banks to lend more. That's the type of thing that I'm talking about. It also is saying, well, if the government's going to write you a check to help you through the crisis, then that's the provision of liquidity as well too. So this is why I'm saying all of these are going. And I'm seeing things in the marketplace that I think are both disinflationary, so I think inflation is probably going to come back again, but equally worrying from an asset allocation point of view as well too, because now with this liquidity is being withdrawn, you can draw the conclusion that probably the stock market's going to have some moments, and we've been seeing that as well too. Interestingly, when you look at dry freight rates at the moment, the Baltic Dry Index, which is a good not leading indicator, it's a good indicator where freight rates are, we're beginning to see that pressure that's built up over the course of the last 12 to 18 months start to ease off a little bit now. Not everywhere, but they are starting to ease off a little bit. So this is quite interesting, right? Suggesting that the growth in demand, which we've seen there from the economy, is maybe starting to tail off a little bit, and we're starting to see some more normalized approaches. One of the key things I think so when we think about the sentiment cycle, right, one of the classic points in the sentiment cycle where you get this divergence, the overexuberance point, and I think we're in the overexuberance point at the moment. Okay, we see and this is a great chart here, this shows the Russell 2000 and the S&P 500, and you can see from this is pretty much since April, the Russell 2000 has either gone sideways. It actually had a breakout to the upside in November, and then quickly failed. That for me is quite a negative signal. So the Russell 2000 represents, if you like, a mid-cap America, and the S&P 500, as we all know, is a cap-weighted index, which is probably over-represented by the so-called FANG stocks, so the big large cap companies. So you can see that defensively, what's been going on is people have almost been putting their money into Apple and Amazon and Google, rather than putting them into any other companies in the States in the last 6 months, because they're thinking that the mid caps isn't the place to be. Now, why would that be? Why would the share prices of some of the smaller companies in America not be performing as well as the larger ones? Well, I can only conclude that the view of the economy is not quite as rosy, perhaps, as people are seeing it at the moment. So when you look at the S&P, on the panel at the bottom is the number of stocks that are above their 200-day moving average, and you can see that number is falling away quite quickly. So this is a momentum indicator, right? It's a breadth indicator. So as the market has been rising, the number of stocks that are rising with it have been getting less and less and less. You can begin to see that in the volatility we're seeing at the moment, and we'll have a look at those charts when we get into the picture in just 2 seconds. So I want to go through what I consider to be the Super 7. So this to me represents the benchmark asset markets in the world at the moment. So a couple of currencies are in there, the euro, US dollar, and the Japanese yen to the US dollar. Now, why do we have those? Well, the euro to US dollar is the exchange rate between the two biggest trading blocks in the world, and dollar yen represents a if you like, a call on Asia. So it's where you're looking at for Asia markets to trade often in line with the Japanese yen. So you've got the two major areas of the world. So you've got Europe and you've got Asia and their relationship to the United States. Then I want to look at one of the key commodities, which is oil. We look at gold and the S&P 500 as the benchmark equity market in the world. The big daddy of them all, which is the 30-year US Treasury yield. And we're also going to look at a cryptocurrency, which is the benchmark one there. I like to use Ethereum for that. So let's start with an overall look at the currencies, direction of the currencies. So this is the US dollar index. So you can see that the US dollar has been rallying. This is a weekly chart going back to the beginning of the year. It was a bit of a boring start to the year, you know, a little bit up, a little bit down. But then pretty much since June, we've seen a consistent rally. Now, I think this has been, in my view, for a couple of reasons. Number one, I think people are getting increasingly concerned about the asset allocation outlook around the world. And for me, the second one is a really simple one, is that as all the commodity prices that we've seen around the world are starting to rally or have been rallying to quite extraordinary heights compared to where they've been almost a year ago, the demand for dollars has been really, really high. You can see the demand here, I think, has really forced the dollar up. So this is quite interesting. So you've had a situation now, up till this point, where the demand for the dollar has been led by, I believe, actual pure physical demand. You know, people just didn't have enough to go round. Now, I think we're going to have a slightly different situation, because if the Fed is starting to taper and not providing additional liquidity into the markets and interest rates start to rise, then you could argue the dollar might take a second leg up from here over the course of the next few weeks, especially against those currencies which aren't looking to raise interest rates. So most notably, the ECB came out during the week, said they had no plans to raise interest rates or to reduce their asset purchases. So there may be a sign there that possibly the long-term outlook for the euro US dollar is actually not bullish at all, and is going to stay in a bear market until the point where the ECB decides to change policy. So let's go and have a quick look at the euro. And for the last 6 or 7 months, it's been a grinding bear market, but it has been a bear market. You know, we've gone from 120 down to 112. And when you look at that weekly pattern, what we're seeing here is we put a spike low in 3 or 4 weeks ago down here. And so far the market has then gone sideways. So what we'd have normally expected, this was a genuine spike low, is we would dip down and we would then try and rally, and we'd end up trying to get back to most recent resistance, which is up here at 116, 117 area. But what's happened is the market has gone sideways. That, for me, is not a bullish sign at all. So if you think about the last 5 or 6 weeks since we broke down from the previous price level, we broke out to the downside, we then broke down again, we've then gone sideways. We've barely retraced 1/3 of this whole move from here to here, barely retraced 1/3, and now we're sitting very close to the previous lows. That suggests to me continuation on the weekly charts. So let's go and look at the dailies and see what the dailies are providing us with. Well, we were fairly constructive in the euro, although the rally days, there was only 3 or 4 of them. Can you see this? Like, there's 1, 2, 3, probably 4 days where the market rallied. The rest of the time it was basically being sold over and over again. So if you think about momentum and breadth within the market, what's going on, just looking at those bars, you can see that apart from the occasional days when the market just had that, okay, it didn't turn out, because the next day people just came back in to sell. They sort of went, oh, a higher price, great, I can sell again, you know, and that seems to be the pattern. And again on Friday that was repeated. We've actually closed, if you look at the daily close, there's only been 2 closes that are lower than where we are now. I would expect follow through on Monday to the downside. Where it's going to go to, who knows? We may set a new low, we may start a new brand new leg down and a breakout. Alternatively, we may just go down and then bounce back again. But one thing's for sure, we're going to probably try and retest those lows down here. So when we look at the, let's move on to the dollar yen and have a look at that. We'll start with the weeklies, as I like to. So again, you can see what's going on here. So throughout 2021, the US dollar has been rallying against the yen. Now, one of the interesting things that you normally tend to get with the stock market starts to sell off, or you get a bit of a flight to quality, is you will find the yen, Japanese yen, rallying, so dollar yen going down. Now, why is that? Well, it's a really simple thing, is that the Japanese export a lot of their money overseas. A lot of their capital gets exported overseas, trying to get a slightly better return than the very low returns which they can get domestically. So they're huge overseas investors. When they see trouble brewing, it's not unreasonable to think that what they will do is to sell some of their investments and then start to withdraw that money and bring it back home again. So that's why you see, in a bit of a crisis period, you often see dollar yen falling. When I'm looking at this chart on the weeklies, what I'm seeing here, without putting any indicators on it at all, is a general upward drift. The last leg of that upward drift, that's the move from 110 here up towards where we are now, was very clear over 3 to 4 weeks, but that was some time ago with almost zero follow through. Okay, so what does that suggest to me? Well, that suggests to me that at some point in time we may be looking at a trend reversal here. I'm quite optimistic that I think dollar yen is going to fall back to the 100 level over time. Its purchasing power parities, there's some fundamental economic analysis you can do, is quite a bit lower than where we sit at the moment. So, from a fundamental economic point of view, we should be a little bit lower. And what I'm really looking at is the weekly and daily technical picture to give me some support for that. So let's go and have a look at the dailies, and maybe we can see the false breakout more clearly here. So you can see the rally up, consolidation, second rally, and now we see the quite obvious correction here, and we had the buy the big dip moment. We came down to the averages, we rejected that, then we went up, and then we completely rejected a brand new high up at 115. Right, just completely rejected it in one day, and then we've gone sideways. So for me, I think the key thing here is a move down below the 113 level. I think will confirm to me that maybe this breakdown that we saw, so the rally and the collapse, if you like, so the failed attempt to go higher, is not going to be repeated. It may be that we drift higher again, but for the time being, I suspect a break of 113 even, to me, this is that low of 113.13 we put in place on Friday. A break of that low to me would be quite negative, and I think we'd see dollar yen go down. At the moment, we aren't seeing signs of a trend reversal. What we're seeing is a consolidation, but it's taken too long for the market to consolidate. We shouldn't have taken this long for the market to move up again. This is quite unusual. So I'm going with this spike high week and this excess point that's been put in place here. I'm wrong if we take out the 115.50, but for the time being, I think this trend could be reversing, and so we could be seeing the beginnings of a move down in dollar yen. Okay, next thing to look at on the chart is oil. So let's go find the oil chart. Just give me 2 seconds while I pull up oil. Where have you gone? Oil. Here we go. So looking at the weeklies, WTI, looking at the weeklies, we saw that incredible move up down from the 35 area, the 30s, all the way up to $85 in WTI. That's of course of 3 major waves to get up there. We've then seen quite a sharp correction. This is when the US began to realize that maybe there was talk of the Strategic Petroleum Reserve being released then. The Chinese were releasing some of theirs around this time. Then the Americans decided to release it. On top of that, we have additional capacity increases by OPEC. I think it was absorbed by the market through September to November, because without the Omicron variant, people saw the pandemics, hopefully, fingers crossed, things were coming to an end and the economic picture was starting to brighten around the world. And as a result of that, if you like, demand for oil was picking up. Well, since the last few weeks, we've seen 2 things happen. We've seen, number one, there's been an increase in supply via central banks, via sovereign nations releasing their strategic reserves. We've seen OPEC Plus increasing their supply as well too. And the market already had a tone of slight oversupply up here when we were trading at the 85 level. And the reason why I had a tone of that was because the market was something we called being backwardated. So the nearby prices in oil were much higher than the future prices in oil. So if you go out a year or 2 years, they were much lower prices, so talking $15 or so. Since the sell-off that we've had over the course of the last few weeks, those prices have almost completely normalized now. There's only a slight backwardated, and in some cases we've gone into a contango market in the oil market, so more imbalance. So if you like, that backwardation where you have higher prices today than there are in the futures market in 1 or 2 years time is a sign that oil is tight, and it encourages people to, if you like, to pump a little bit more and get the oil out of the ground. So they would have agreed prices here and they're pumping, and now of course they've pumped a little bit too much, and here we have the prices normalizing again, as well as the pandemic effects too. So the impact of Omicron, and I think the impact on confidence that Omicron is having on personal travel, has meant that on the margin the demand for oil is actually starting to wane again. So you've had demand starting to fall back at the same time as the high prices have produced quite a bit of supply. So when we look at the daily charts here, we can see the market sold off quite aggressively. We had a couple of days where it was incredibly volatile. We put a spike low in place down at 62. That's held for the time being. The market's rallied back, but now look, we haven't set off to new highs again, breaking out of this trading range. We've actually closed on the weekly chart at the bottom of this trading range. So for me, I think one of the key things to note here is there's been quite a number of poor closes that happened yesterday in some of the markets, and I think we'll see follow through to the downside again in oil as well too. It has bounced, so you could argue that this major move that we've seen could be close to the lows. I'm not sure it is. If you study the sentiment cycle, you'll know that this is wave, if you like, this is the last but one wave. So I think we need to have one more final test. And then if we put a higher low in place, I'll be much more aggressive about thinking about the long side. If we don't match that higher low and we manage to break down to a new lower price level, then watch that carefully. But if that doesn't respond either, then oil could be in a slightly more protracted bear. However, having said that, right, guys, it's seasonal time, right? This is seasonally the worst time of the year for oil, and we've seen that unfold through November and December with the price action. That changes come about mid-January. The oil market seasonals look a little bit more positive, and through February, March and April where they're very positive. So if you like, we get this, if this bear case is going to unfold, it's got to do it over the next 2 to 3 weeks. After then, I'm turning into bull mode on the seasonality, and as a result of that, I think the market will start to reflect that as well too. Oil's really good about running seasonals. It may be different this year, but it has quite a high hit rate for that seasonally bullish time in Q1. So watch this. Right, this is quite important. We're looking at a potential secondary, a higher low in oil, and watching very closely as we try and retrace back down towards this 62 area to see what happens next. It could be a big buy signal, could be continuation. We're going to see how it unfolds. So watch that one really carefully. Okay, talking about gold. What are we seeing in gold? Well, gold for the first time in some time, picked up a little bit over the course of the last couple of weeks. I don't think I need to even have a chart up of gold for those of you who've been watching it. This year has been a pretty rubbish time for gold investors. That's this year. It's pretty much gone nowhere. You compare this to the S&P that's up 17 or 18% or so, and you can see that this is a pretty bad year as far as gold investors are concerned. I'm just going to go with boring. When you look at the broader perspective, the broader charts, it seems to me to be consolidating at the moment. It's taking its time to consolidate, but it seems to be consolidating. It isn't necessarily in a bear market. So the average cost price for gold is down at about $1,100 to $1,200. So at the moment we're trading well above the cost of producing it. However, when you look at some of the mining stocks, they don't tend to reflect that. So if we look at some of the gold mining stocks and look at where they stand on the weekly charts, you can see that we're looking really here at an environment which should be incredibly profitable for gold miners in terms of the spread between what it costs them to make it and where they can sell it in the market. But this isn't the market that's trading at new highs. In fact, throughout this year, it just seems like people have just got bored of it and they don't like it anymore. So I would be thinking around this to say, actually, what I'm seeing here is a market that's underowned, that is off people's radar screens, that is interesting, and if it does start to move, I think we'll see a lot of demand coming into it, either from the long or from the short side. So with that said, what's the key levels? Well, the key levels for me have always been the 1760. That's been a pretty key support now, going back months and months and months. And we had a test of that during this week. So with the Fed meeting, the market went to have a look and maybe have a look at whether there are any stop losses. But what it appeared to happen on Wednesday or Thursday morning, depending on where you are in the world, the market went down. The gold market went down during the Fed, after the Fed announcement, and then bounced back really smartly. And then on Thursday and Friday, we've then seen improved price performance. Setting a new high of 1814, which is, if you like, the major resistance. You can see that from these previous levels here, and closing quite well. So on the week, where did we close? We had an outside week, but it was a bullish outside week. It was a pretty boring week the week before, quite frankly. But you can see how the market hasn't had that outside week up. I view that as being quite a positive sign for gold. So where are you wrong, right? On the weekly chart, you're wrong in gold if we take out that 1760. And beyond that, it seems to me that maybe the case could be for gold being more bullish than it has been in the past. Right, now, what about seasonals? The seasonals at this moment in time also kicking in a favourable light. So I think the cycle date was about the 16th of December. It's normally when the seasonals start to kick in, and gold has performed really well since that day. So again, looking at the chart, what we're seeing here on the daily chart is we've had 2 days of really solid. We've had a day of excess on Friday. The market obviously overreached itself, getting up to that 1815 level, and came back late on Friday. Let's see what happens on Monday. Another clear buy signal would be gold taking out the 1815 level. So we've got 2 major levels, right? We've got 1760 weekly chart downside. Think about it that way. We've got 1815 on the top side, continuation. Think about it that way. Okay, right, now let's go and look at a couple of let's go and look at the stock market for a second. Let me just grab my stocks, and here we go. So we've talked about how the market's performing relative to the smaller caps, how the S&P 500 is performing relative to the smaller cap stocks in the States and elsewhere. Now let's look at the individual market itself. I'm not going to bother you guys with weeklies. You can all go look at this chart. I really think the dailies for me are quite important. And it's very obvious the minute you start to look at this that you're seeing some volatility start to enter the marketplace. Look at the average ranges that you had here, and look at the average ranges you've got here. Yes, there were some ups and downs in all of this, but the volatility is starting to pick up. Overall, what we've seen is a rally, a very volatile selling period, a retest. We've seen a retest that's been rejected once, twice, and now 3 times, with increasing bar size each time, and now we've closed on a low point for the last week or 2. This for me is quite a negative signal. We may end up going sideways from here, who knows. And gosh, I'd be the first person to say that stocks really fight the let's go down moment, especially the stock indices. But for me, when I look at this chart, technically this is beginning to exhibit the signs of a market top. And although there's normally a Christmas rally, I think the Christmas rally could be a little bit disappointing this year. And in fact, the way this market trades could be quite negative for the next few days. I would like to see, when it comes to negative, a significant break below that this level down here, which is a 4,500 level, and a close below that. I think that will give me more confidence that maybe something is going on to the downside. Until that point in time happens, I think this is mildly bearish from a price action perspective, mildly bearish, but that's all I can really say. So call it a weak bearish signal. Realistically, we are trading within 50 or 100 points of all-time highs, right? So, but the market appears to be starting to roll over. So what I was talking about earlier, you withdraw this liquidity, you withdraw, start to tighten the market, the central bank starting to turn around and say that's enough. We've got to do something about inflation. And with that withdrawing of liquidity, I think we're beginning to see how this is unfolding in terms of the asset market. So just bear this in mind, right? We need two things to happen. We need that central bank liquidity to be withdrawn, and we need the fiscal stimulus to starting to be withdrawn as well too. So again, we see the sign of the government starting to pull back, begin to raise taxes or reduce spending, and I think that will be like a double whammy for the asset markets, and most notably the American stock markets. There's been so much money invested in stocks this year. I think the numbers are crazy, right? It's like there's been as much inflows into the stock market this year as there has been in the last 20 years combined, right? So it's an extraordinary amount of money has found its way into stocks, both from a retail and a wholesale perspective, and maybe we're starting to run out of steam on that. Okay, let's have a quick look at the long-term interest rates. So here I'm looking at the yield on the 30-year government treasury bond for the United States. Now, why do I look at this? Guys, this is the most important yield in the marketplace, and despite stock traders saying otherwise, bonds are simply by far and away a much, much bigger market than stocks. So when you're thinking about interest rates, I don't necessarily think about what the Fed is doing. For market confidence and for market indicators, I look at what the long end is doing, and you'll see from these yields, right? 181. The reason why I look out this far is because the government doesn't have as much control. The Fed doesn't have as much control of this part of the yield curve, right? You could argue that they can change short-term interest rates and the market responds. The Fed doesn't really do that many asset purchases beyond like 5 or 7 years. So when you think about some of these interest rates, they're really set by the market. Now, it's obvious to see 1.8% is not 7% in terms of where inflation is. So you've got a negative real yield. Okay, so if you buy a bond this year, you're going to be 7% worse off because or 7% minus the yield, which is 5%, be 5% worse off for your money. So if you buy a bond, the bond might go to 102, you get paid a 2% coupon, so it goes to 102 by the end of the year, but unfortunately inflation means that it's only worth 95 compared to what it used to be. So you can see that there's massive divergence between long-term interest rates and where the inflation is at the moment, which is the reason why I think inflation is still, in my mind, remains transitory. Now, what does the bond market know? So interest rates are very low, they remain very low, and if you go and look at a shorter term chart, we'll just pull up a daily chart here on the daily bar chart. You can see just look at the last few days, since we've had that volatility in the stock market, then yields have generally been trending lower. You know, we've gone from a yield level of about 210 down to about 180 at the moment, and that hasn't been the low point. So, and again, another close on Friday, which was at the bottom of the trading range, which suggests to me that yields might end up going lower again on Monday or next week. So no particular signals from the bond market here to give us any indication, apart from the fact that yields remain incredibly low. Okay, so the last market that we're going to look at as we run through our collection is the cryptocurrencies. And again, we'll look at Ethereum because that, I believe, is the benchmark as far as I'm concerned. What's been happening over the course of the last 2 years, we've seen a rally, and in some cases, if you go back to 2020, a significant rally. We're just looking at roughly here at 2021. We've gone from about 1,200 up to 3,900. So this has been extraordinary, right? This is an extraordinary rally in the cryptocurrencies. You can't say anything other than, for the time being, this market continues to go from the lower left to the upper right. So on the weekly chart, it still looks fairly positive. The warning signs are there. We've had the last few weeks. We rarely get 2 or 3 closes on the weekly chart that then don't turn into something quite bullish. So have a look at this, right? So if you look at the analogs in the past, we've had 3 weekly closes here have led to a big rally. 3 weekly closes here have led to eventually a rally, and I haven't got the analog to go back. We'd have to go back and look at trying to find 3 weekly closes. I think, of course, everything a bit different. There we go. There's 3 weekly closes there and the market rallied, and then 3 down weekly closes there and the market then rallied again. So there's a bit of analog evidence to suggest that 3 weekly closes could turn into something quite interesting. When we look at the daily charts, what are we seeing here? Well, we had that spike low, that massive sell-off that we had over the course of, I think it was a weekend actually, about 2 weeks ago, where we had a significant move down. I think Bitcoin lost 15 or 20%, and similarly Ethereum, when it went from 4,700 all the way down to 3,400, extraordinary levels. triggering a lot of stop losses, I'm sure, from people. But the market bounced back really quickly. We've now tried to work our way down to these low levels that we saw during that sell-off, because I believe it was over a weekend, or you didn't have much chance. Certainly you had very little chance to be involved in it. We've now seen the market work its way down here, but we haven't broken this spike low. This for me remains a positive sign for Ethereum. We've had those 3 weeks down, which we know from an analog perspective can turn out to be quite positive. The cycle dates, I think, are starting to line up now as well too. The short-term cycle dates starting to line up for a more bullish pattern. I believe that Ethereum is going to trade reasonably well over the course of the next few days, with the proviso that if we break through this spike low down here, then all bets are off. So if you like, for me, there's a major stop loss there below the 3400 level. Apart from that, I'd be thinking about being involved on the long side for the next few weeks. And again, how you guys do that is up to the different systems that you have. You know, when we look at this pattern, it still remains overall bullish, although we probably shouldn't have had such a large retracement. So again, we're not expecting a huge amount. If we are going to rally, maybe a retest of the old highs, I'd certainly be thinking about a target price towards the 4900, 4800, 4900 mark for where the market is. Folks, that's all we have time for this week, and as always, you know, if you have been, thank you very much for listening. I hope you found this informative. I've tried to keep all the indicators off the chart this time to give you guys just a feel for the price action. I always encourage everybody to have a look at charts without indicators to get a feel for the price action. Where has the market opened? Where has it closed? What's the feel for the market just by looking at that open-close relationship compared to the high and the low, and looking back at what's happened in the past as well too. And Ethereum is a great example of that with that analog. You know, it's very simple to go back and look, just find the last time we had 3 weeks down, what happened. There we go, 3 weeks down. Okay, 2 weeks down, we normally tend to have a bit of a rally as well too. 3 weeks down, we've had a rally. We're now 3 weeks down, so that tells you that maybe we're due for another rally again, just looking at it from an analog perspective. Guys, thank you very much. If you have been, like I said, if you have been, thank you very much for listening, and I'll speak to you next time. And if I don't see you before Christmas or speak to you before Christmas, have a fantastic festive holidays. Enjoy yourself, get some rest. It's been a crazy year, and we'll start again in the new year.